Welcome to the weekend edition of the Fear and Greed Business Headlines, the week that was, a wrap of the biggest stories over the past 7 days. I'm Sean Aylmer. It was a week full of economics, politics and market volatility, with just a dose of international drama thrown in. Starting with markets, the shift from pandemic-era stocks to cyclical companies is in full swing. Most of the companies that did well during the pandemic are underperforming now, whereas those that lost ground because the economy slowed in 2020 are now picking up again as the outlook improves. On Wall Street, that's best highlighted by the massive tech stocks, Apple, Microsoft, Tesla. They've lost value, whereas the financial and energy companies have done well. Back home, the big consumer staple companies, think Woolworths and Coles for example, and some of the other online retailers and tech stocks like Appen and Xero had a cracking 2020, at least in share price terms, as people shopped online and stocked up their pantries. But they've fallen out of favour this year, replaced by media and property companies, the big four banks, oil and gas groups, and other businesses that tend to do better when the economy grows. The miners are the outliers. They do well when the global economy improves, though they're very reliant on commodity prices. Oil prices were trundling along all week until the Organisation for Petroleum Exporting Countries, better known as OPEC, met late in the week and decided to hold back production. That sent oil prices much, much higher. Gold had a pretty sedate week, while Bitcoin did its usual trick. About 2 weeks ago, the cryptocurrency hit a new high, then it tumbled 20%, and this week it zoomed up again. Bond markets continued to get plenty of attention during the week. Rising bond yields suggest investors think there's a whiff of inflation in the air, both locally and globally. Making money from bonds is going to be much tougher in the future. In fact, the world's greatest investor, Warren Buffett, provided his annual update this week and said bond investors faced a bleak future, notwithstanding his own group, Berkshire Hathaway, has about $113 billion worth of short-term bonds. The overseas coronavirus news was good and bad. Cases are falling in many countries, which is great, but the rollout of vaccines hasn't been going to plan. Early in the week, the US Food and Drug Administration approved Johnson & Johnson's vaccine. Great thing about that jab is you only need one, and it doesn't have to be stored at very low temperatures. But late in the week, Italy blocked 250,000 doses of the AstraZeneca vaccine from heading to Australia, citing new European Union rules. The Chinese Communist Party met this week to approve a 5-year blueprint for the world's second-largest economy. The party is making big bets on emerging technologies from hydrogen vehicles to biotech and wants to reduce its dependence on the West for crucial technology parts such as computer chips. And the Biden administration released its national security policy and put Australia at the centre of its Asia strategy. Nice to have friends, but I'm not sure Beijing will be impressed. There was plenty going on in Canberra this week. It started with Federal Treasurer Josh Frydenberg talking about superannuation, saying super funds should offer new retirement products so people spend more of their money in their final years, rather than keeping it all and bequeathing it to the kids. That might solve some of the problems in super, he said. Then things really heated up. The government released the Royal Commission final report into aged care. The 2,000-page report includes 148 recommendations and makes it clear the government will have to spend billions of dollars in coming years to fix the system. Too many old people don't receive the care they need. Staff levels are too low, and the system fails those with special needs. It is a national disgrace. And while the Treasurer Josh Frydenberg said the government won't increase levies to fund the system, I'm not so sure it's that bad an idea. That should have dominated the headlines for the week, but instead the Attorney General Christian Porter did. He outed himself as a federal MP that had had allegations of rape made against him. The claim involved an incident 33 years ago, and the woman involved tragically took her own life last year. Mr. Porter vehemently rejected the allegations and has taken some personal leave, though won't step down as Attorney General. Then Defence Minister Linda Reynolds came under fire after it emerged she called former staffer Brittany Higgins a lying cow after Ms. Higgins went public about an alleged rape in Parliament House. Prime Minister Morrison is under pressure to take some sort of action. There was plenty of bits and pieces of economic news around. Job ads jumped 7% last month, the most since October 2017. The trade surplus in January shot up to $10.1 billion, and building approvals in January slumped after a huge rise in December. There was some good news for local farmers. The value of production this financial year was expected to reach an all-time high of $66 billion, reflecting the breaking of the drought, a great winter crop, and high meat prices. The average national farm income was forecast to rise 19% to $184,000 per farm. It's about time the farmers got a break. With earnings season over, there was less profit and loss activity, but still plenty of corporate movement. US-based fund manager Ares Management will buy 60% of AMP Capital, the fund's management arm of AMP, for $1.35 billion. The new joint venture will target infrastructure debt and equity and property. Australia's largest waste management group, Cleanaway, has approached global giant Suez about buying its Australian assets for an estimated $2 billion. And cloud accounting software group Xero has spent $242 million on a Danish workforce management platform, Planday, immediately adding 350,000 new customers. There were still some profits around the place. Harvey Norman said its profit for the final 6 months of last year had almost doubled. Department store Myer said it had made a profit, thanks to JobKeeper and rent waivers, and Kogan.com said its profit was up 164%. So, out of those three, guess which is the biggest company in terms of market capitalisation? Harvey Norman, Myer, or Kogan.com? Harvey Norman is worth $6.6 billion. That's 4 times bigger than Kogan.com and an incredible 27 times bigger than Myer. The once great department store appears to be in its sunset days. Another story getting plenty of acreage in the financial pages is about Greensill, a finance group owned by Australian billionaire Lex Greensill. The group buys up invoices from suppliers of its customers, pays them for a fee, and chases the debt. It's called supply chain financing, and Greensill has an A list of global clients. But the group's prospects now look unclear after German regulators cracked down on the group and global investment bank Credit Suisse suspended $10 billion worth of funds linked to the firm, citing uncertainties about the valuations of its assets. Things do not look good. The week was full of corporate movement at the very top levels as well. Crown Resorts director John Poynton stepped down, taking to 5 the number of board members that have left the gaming group in the past month. Rio Chair Simon Thompson said he won't seek re-election following the Yukon Gorge disaster last year, and Nine Entertainment and QBE both got new chief executives. And finally, in corporate news, Qantas said it might end up retrenching more than the 8,500 people already in line to go, depending on the outlook for travel. Now I get to the point in the program where I go through the biggest story of the week, the sleeper story, the most remarkable story, and of course, my favourite story. The biggest news story of the week was the economy. Official economic growth figures showed an expansion of 3.1% during the December quarter, following a 3.4% pace of growth during the September quarter. It was the first time in 60 years of keeping records that Australia had 2 consecutive months of 3% growth. For all of 2020, the local economy contracted by 1.1%, thanks to a massive 7% slump during the June quarter. Still, the result was much better than most other developed nations, and within the next 6 months, Australia will be back to where it was, in an economic sense, pre-pandemic. The figures came after the Reserve Bank said it still intended to keep the official cash rate, which lenders use to set short-term interest rates, at record lows for another 3 years. The central bank wants to make sure the employment market gets back on track before rates rise. It agrees the economic recovery is underway, but the road will be uneven and bumpy. The sleeper story is heavily intertwined with the biggest story of the week. While the Reserve Bank wants to keep rates low, an organisation called the Council of Financial Regulators has warned that lending standards set by banks and other financial institutions could be tightened. That would make it more difficult to get a home loan and could be used to cool the market. It's the sleeper story because it didn't get much attention, but also the people on the council have some serious sway. It includes the Reserve Bank, Federal Treasury, the Australian Prudential Regulation Authority, and corporate regulator, the Australian Securities and Investments Commission. The most remarkable story involved the housing market. Each Monday I talk about weekend auction results and clearance rates, and they've been pretty strong. But this week we got official confirmation that despite suffering the first recession in 30 years, house prices jumped at their highest pace in 17 years during January, thanks to the low interest rates and confidence about the bounce back in the economy. House prices in Hobart, Canberra, Brisbane and Adelaide are all at record highs. The laggards in terms of growth are actually Sydney and Melbourne, which have suffered from the lack of immigration during the pandemic. It truly is remarkable that house prices can be at record levels after the year we've just been through. I don't think it's particularly rational, and I fear that when interest rates start to rise, and they will, many people might struggle to repay their loans. And my favourite story this week comes from a company called Lynas Rare Earths. Its earnings jumped sharply to $41 million for the December 6 months. Rare earths are used in electronics and batteries, and 80% of them come out of China. The interesting bit is that Lynas is benefiting from being a non-Chinese producer because the US and other manufacturers want a source of rare earths not in China. Lynas' share price is up more than 270% over the past year. It's an Australian company competing in the big global market, and it's doing it well. That's why it's my favourite story. And that's everything you need to know from the last week. Hope you enjoyed it. I'm Sean Aylmer. I'll be back on Monday morning with the Fear and Greed business headlines. I look forward to your company then.